because I don't know when the dookie's going to hit the fan and the fan's going to start spinning and spin off and hit me in the head. But I want to be prepared for the fan to hit me in the head. I want to put a helmet on first so I can, live to talk about that, because if that fucker came down on me, it's going to hurt. And that's exactly what potentially could be happening in the economy over the next 6 to 12 months. Again, it is an election year. You would see a lot of stimulus in that event, but then you kind of bring up the argument of, if the government spends even more money from here, as governments and really people are revolting against treasuries, you can see that in TLT. Nobody wants to buy a dang treasury bond. You almost can't pay people enough to buy treasuries. Well, that's an even bigger problem. If the Fed starts to, print even more money and the government starts to deficit spend even more, you might see treasuries spin out of control into a sell-off that could drive rates higher even as the Fed is cutting rates. That's the dangerous part. If the Fed cuts rates and the bonds don't react, then you're talking about a collapse, a calamity, a total problem. And I guess we'll know that when that day comes. But you want to be prepared for that day long before it comes. And I think the time is now to prepare for some kind of downside, right? Stocks are at all-time highs. There will be downside at some point in 2024. Question is it, moderate? Is it a correction? Is it a 20% crash? Is it a total collapse? We don't know, but the signs are out there that, maybe the economy's not as strong as we thought. Here in this video, we are going to be going over a couple different things, including Tesla on a technical basis and what's coming next for Tesla stock. In this upcoming week, Nvidia earnings are probably going to be the thing that moves Tesla the most. We are also going to take a look at the 13F filings that are coming out in Tesla stock. Are hedge funds and institutions buying this dip in Tesla, or are they selling Tesla stock? But I think even more important than that, we are going to take a look at what's going on in the world and for the US economy. As some of you guys may or may not know, Japan just surprisingly went into a recession when they were not expected to. Is the music about to stop for the US economy as well? Some troubling signs out there that I think you need to know. I will overall give my opinion on this, and keep in mind, it is an election year, and that is the equivalent of, well, a nuclear bomb, a sex scandal, or something else terrible happening under your watch. If you are young Biden, well, you cannot afford for that to happen. So keep in mind, it is, highly unincentivized to see a recession in 2024. And if we even get close to that, you're going to see rate cuts like you have not seen them in a very long time, potentially ever before. Could these massive rate cuts, if that is what ultimately happens, be positive for Tesla, or would that be a negative for Tesla stock? We have all of the details and everything you need to know coming at you in this video. Hit the like button and subscribe to the channel, because why not? It's free 99. It costs you absolutely nothing to do so, and after all, there's not too many things these days that are free. The land of the free is in fact the land of the worker bee. So yeah, having the liberty to hit that like button and or subscribe to the channel is, well, a pretty cool thing. Not just because I think it's cool, ask your friends, they'll say it's cool as well. In all seriousness, let's get started with the video. First up, the thing that's gonna move Tesla the most in the near term is Nvidia earnings. That will be happening on Wednesday, and mark my words, I think there is a 95+% chance Nvidia falls after earnings. Now, this time around, as we have talked about before, Nvidia, well, is pricing about an 11% move, which would be on par with one of the largest market cap moves in history. This would rival Meta's market cap loss when they reported that first really bad quarter and Meta started its downward slide to about $88 per share. Yeah, Meta lost about $220 billion of market cap that day, and Nvidia could do a similar event coming this upcoming week. Now, I say that tentatively because Nvidia is probably going to smash earnings. The question is, what does guidance look like, especially around pricing for their GPUs? As I'm sure most of you guys are not aware, these H100, A100 GPUs should not cost $35,000. The actual retail selling price should be about $8,000. There has been a very long wait time for these GPUs though, and that means companies are willing to spend more money to get their hands on them sooner. We did recently get some news that GPU lead times have went from 8 to 11 months. This was back like last quarter, right? The quarter that we're going to get numbers for like September, October, November, December. In this time frame, it was 8 to 11 months before you could get your hands on these high-end GPUs. Well, UBS just came out a couple of days ago and they said now it's 3 to 4 months, which that's still a wait, right? But that could put some pressure on pricing. And think about it like this. Nvidia's year-ago quarter, Nvidia brought in $7 billion of revenue. Well, the pricing of GPUs has skyrocketed since then, and now it's $35,000 for a GPU. Well, if Nvidia says pricing could be under pressure over the next couple of months, or some point in 2024 with their full year guidance outlook, Nvidia stock is not priced for that kind of bad news. Now, to UBS's credit, they think the drop in lead time here is because more supply is coming online, not because demand might be slowing down. I make the argument of how many GPUs do you really need? It seems like the largest companies in the world are the biggest buyers of these GPUs. Meta, Tesla, Amazon, Microsoft, they're the ones buying these GPUs. And I'm sure at this point, they might start to slow down. It's been now over a year of a frenzy to get your hands on these GPUs. And this is much the same as the pull forward in demand you've seen for goods products in 2020 and 2021. Everyone went out and bought a dang computer, an iPad, a TV, this and that. Now those things are not doing so well right now. So it's only a matter of time before the sales slow down of these GPUs. When the sales slow down, pricing will collapse. And that's actually what some of your data experts have been pointing to. Now, over the past couple of weeks, you've actually been seeing a massive price drop in your more or less gaming GPUs. Very high, kind of higher end GPUs. You can see AMD Radeon RX 7900 XT prices dropped to $699, surpassing the Nvidia RTX 470 Ti Super. You can see that prices are falling back to MSRP. This was 4 days ago. That was a week ago. It says Nvidia GeForce RTX 490 prices are on the decline in Europe, but I'm still not seeing any bargains. That was 3 days ago. There's actually been a fall in these graphic card prices. Now, is that going to affect AI graphics cards, GPUs? Yet? Probably not, but I could see that being an issue in 2024, especially considering the lead times have fallen. And that is, again, what a lot of experts are continuing to forecast. But those experts that are forecasting this are not Wall Street analysts. They're different data companies and different experts in their fields, but they're not analysts. So Wall Street is not picking up on this. One analyst last week said Nvidia is too frothy. I don't know why I have an ad right in the middle of the headline. That's a little ridiculous. Little too frothy, and its price will fall from unsustainable highs. He says, quote, I think the price that it's at right now is very, very, very hard to maintain. Clio Capital's Sarah Kunst said in a CNBC interview, while other tech stocks have seen huge gains over the last few weeks, they're foamy, but Nvidia is frothy with a price to earnings ratio of 97. Again, you're not priced for growth slowing down, especially not pricing slowing down in GPUs. And if there is anything that causes Nvidia to fall, it's probably pricing coming down for those GPUs that will compress margins. Beyond that, it looks pretty clear over the past 3 earnings where Nvidia has seen blowout earnings and blowout guidance. The stock has ended up falling anywhere from 10 to 22% over the next 4 weeks or so. post earnings. I don't think this time is going to be any different. I think it's highly unlikely Nvidia just continues to rocket higher from here. You could also make the argument that this 50% move higher you have seen in Nvidia since the start of 2024, a lot of that has been fueled by option activity, and market makers need to start unwinding some of those bets as their positions in Nvidia are getting massive, and that could make the move even larger post earnings for Nvidia. But that, my friends, is good news for you as a Tesla stock investor. I've went over this relationship a couple of times, so I'm really not going to do so as much here in this video. If you want to look at it, it's very easy to do. Just look at the last red days Nvidia has had, and they will match up to Nvidia being red, Tesla being green. Besides on Friday, Nvidia was technically a little bit red Friday and after hours, and Tesla was down about 0.25%, a little bit worse than Nvidia, but that was really due to hotter than expected core PPI. And this relationship with Tesla and Nvidia, where if Nvidia sells off, Tesla does well, it only works as long as there's not any economic data or there's nothing external affecting the markets. With nothing else happening, good or bad on any given day-by-day basis, then you see the relationship very strongly with Nvidia and Tesla. Now, if Nvidia does, let's say, sell off what the options market is implying, 11%, that could lead billions of dollars to head into Tesla stock, and that would cause a huge move higher. Now, on a technical basis, Tesla stock, I mean, there's really never been a clearer sign that Tesla's probably going higher. On the short term, ever since Tesla's last earnings, you have a very clear inverse head and shoulders pattern. I've been talking about this ever since really February 14th, where this inverse head and shoulders pattern has been fully formed and fully recognized. What happened? Well, on the 15th, you rallied 6.22%. On Friday, you were slightly down, but I do think there is potentially a lot more upside to go in Tesla. Just to get to the gap fill level, you have to get to about 207. You could make an argument to fully fill that gap, and just an overall round number, 210 looks like the obvious next stop. Now, that's only $10 higher from here. On a percentage basis, that would only be like a 5% move higher. So I don't think that's going to be too hard to obtain if Nvidia does have bad earnings. If Nvidia has bad earnings, or if the stock just sells off in general, Tesla stock could go much higher than that. I'm actually targeting that 50-day moving average around $220 per share. If you can get up there, I'm sure you find some resistance there, and then it's really going to be a toss-up, and we'll have to come revisit the technicals a little more. But I think we have about $20 of upside here that should be pretty easy to obtain, albeit considering Tesla was oversold on the RSI, you went positive. Typically, when Tesla does that, you head to about 70 before you find resistance again. Almost every single time you hit 30 on the RSI, you rally to 70. You hit 30, rally to 70. Hit 30, you did only rally to about 63 here. That was a very large move, though. That was a move from 214 up to about 280. So even though it wasn't that big on the RSI, it was a big move. The last move in which Tesla was oversold bounced to about 66 on the RSI. Tesla stock went from 193 up to 265. So in context to the other moves that we have seen, from a low on the RSI to a high on the RSI, I mean, you're just barely getting started in terms of what is likely to happen next for Tesla stock. Now, I have also been very vocal on this. I think in the longer term, let's say the next 3 to 12 months, you probably start to get the markets switching from a GPU craze, the hardware that actually will, allow real world AI to take hold. That's your GPUs. Your GPUs are the hardware play in AI. And the markets might start to say, hey, who actually has real world AI that'll make a difference, that will create more value for society? And I think Tesla is the only viable answer there as far as, TAM, right? Every household could benefit from FSD or, humanoid robots when that time comes. Everyone. Literally, there's not a person in the world or developed world that could not benefit from their cars driving themselves safer. Hopefully wouldn't be any, accidents or car deaths out on the road. Imagine insurance costs. Well, you could bankrupt the whole insurance industry if FSD was widely adopted. Yeah, so there's a lot of value creation there. Everyone could benefit from that. A Palantir, Microsoft, these are more corporate AI related, and I do think they'll have their time as well, but potentially the real world AI could start to be factored into Tesla stock a little bit more. As Tesla sits at about $200 per share, there is no AI valued or baked into the valuation with Tesla. That's something to keep your eyes peeled over the mid to longer term. The way I look at it is, if I can buy as many shares of Tesla as possible before the markets do realize the potential of Tesla's real AI, that's what I want to do. That's a gift to me because you make the money when you buy a stock, not when you sell a stock. So I want my positioning to be as bullish as possible, as large as possible, heading into the moment the markets realize, wow, Tesla is the real AI play here. With that being said, if we take a look at the 13F filings, we are seeing some very interesting positioning out there. Now, if we take a look at some of the largest positions, Legal and General Group, PLC, they increased their position by 26%. They now own 21.66 million shares of Tesla. If you take a look at UBS Asset Management, they increased their position by about 2.5%, and they now own 15.5 million shares of Tesla. BNP Paribas Arbitrage, they increased their share position by about 8.39%, owning 3.2 million shares of Tesla. Allmitter Capital Management bought a new position of 156,000 shares. Walleye Capital increased their put position by about 27%, increased their call position by about 3%, so that's a little bit more on the bearish side. Lorient Capital Management, they decreased their put position by about 29%. Marshall Wace, they increased their share position by 52%, bringing that total to 1.3 million. CEI Investments increased their share position by 15%, bringing that to 688,000 shares. DE Shaw, they did reduce their share position by about 23%, owning 2.1 million shares of Tesla. They also did decrease their put position and added to their call position. Let's see. Group 1 Trading, they own a call position of 10.3 million shares. They own 323,000 shares of Tesla. They increased that by about 320% in the last quarter. And their put position, they decreased that by about 3%, owning exposure to 2.7 million shares of Tesla. Some Belvedere Trading, pretty even here, about 8.4 million shares in their call position, about 8.3 million shares in their put position. You kind of get the idea. For the most part, these firms are adding to their positions. Cube Research and Technologies, they increased their position by 631% in Tesla stock, owning 138,000 shares now. And there's so many filings, it could take forever to go through all of these. But for the most part, they're either very small reductions or outright huge adds to Tesla. That's the big theme that I'm really seeing here. Now, you're seeing a lot of put positions actually being wound down as well, because doesn't that make sense? If Tesla's went from 265 down to 175, it would make sense to reduce your put exposure at that point, unless you thought a larger collapse was coming. But what's actually very interesting about Tesla is some of your biggest firms like Sequoia and Jane Street and State Street and all of these big guys, JP Morgan, Morgan Stanley, I couldn't find any new filings from them yet. So it doesn't look like they've actually filed their 13F filings, which I did find interesting. But if you take a look at Vanguard, they are the second largest owner of Tesla stock. Go figure, right? They did increase their share position by about 5.5% in the latest quarter. They own 7.23% of Tesla shares. And BlackRock did increase their position in Tesla by about 6%, and they do own about 6% as well of Tesla stock outstanding. So overall, I would say net positives so far from what we're seeing with the 13F filings, but there is still more to come. The UK and Japan have now slumped into a recession while the US economy apparently keeps treading along. Now, there are some problematic signs out there that the US economy may not continue to see the music play. The music may be about to stop. Last week, we had retail sales come in at negative 0.8% on a month-over-month basis. Last month's positive 0.6% retail sales came in at a revised 0.4%. So last month wasn't as strong as we thought. And the data that we just got was much worse than we expected. We were actually expecting a negative 0.1% rating. You came in 7 times worse than the estimate. Nobody was correct. Everyone got that wrong. And we're seeing some signs that maybe the economy is just not as strong as we thought, which is ultimately good news for the Fed, because if the economy weakens here, then they'll be able to cut rates. And let me tell you, the Fed wants to cut rates. Listen to any of them speak. They're pretty dang bullish, and it's very political right now as you are in 2024, and it's an election year. The last thing you want, if you are Jerome Powell, if you are the president, if you are anyone in government right now, is a recession, because people vote based on how they feel about the economy. They don't vote on the best policy, and unfortunately, they don't vote on the one that is going to spend the least as far as the government. Hopefully one day we get some positive feedback from Americans that we don't want any more spending. We don't want the dollar to collapse and lose its reserve currency status. We don't want to pay 15% for mortgages when that happens. Hopefully, topic for another video, but hopefully that happens at some point. Nonetheless, if we do start to head into an actual recession, you are going to see rate cuts, not 25 basis point rate cuts. You're going to see 50 or 100 basis point rate cuts, and that would cause a lot of fear in our market. Good news is, even if the economy weakens, by the time it's already weak, we're going to probably be in a bad spot, but it's going to take some months at the bare minimum. The data that we get works on a month-by-month basis, and it works sometimes on a 2-month lag. So by the time, let's say the economy is weakening now, by the time we actually knew about that and the Fed was cutting rates, it's going to be mid-year at the bare minimum. Now, historically, after the first Fed rate cut, if the Fed is cutting because of a weakening economy, which looks like the direction we're heading in, I mean, the Fed doesn't look like they're in a huge rush to start dramatically cutting rates until something out there breaks, the average pull down in the markets is about 23%. Now, just arbitrarily taking a look at the S&P 500 and your big tech stocks and their valuations, we're not pricing in the chance of that even happening, which is quite astonishing given the bad retail sales that we just got. Everyone just looked at each other and said, "We're fine, soft landing or no landing, no recession, no landing, everything's just peachy." Now, I'm more in the no recession camp than not. But I'm not oblivious to what could happen, right? The markets right now are oblivious to the possibility of a recession. And you can see that just looking at the S&P 500. If it looks like we're heading in that direction, the music could stop and you could see a lot of downside in the S&P 500. Just take for an example, back in October of 2022, when everyone was fearful about a recession in 2023, look what happened to markets. The Nasdaq sold off 38%. In 2022. That was without a recession. If you go into one, that's a whole different story. Or if the Fed gives you emergency rate cuts, which that's what it could look like, yeah, we're in a whole different ballpark. Now, here's a pretty interesting chart. This is the US money supply and the stock market. This is the M2 money supply. So the money supply has actually been falling as stocks have been rising. Historically, this does not happen. Historically, markets rise and the M2 money supply also rises. But that is not what's happened over the past 2.5 years or so. Which does, explain the lack of breadth in our markets, why only a couple stocks are leading the markets higher. And take a look at this. The U.S. federal deficit adjusted for inflation since 2020, so just the last couple of years, you could have paid for World War One, World War II, and from 1970 through 1990 of deficit spending. That is insane in just the past 4 years. Think about how much carnage in the first two world wars, and then 30 years of deficit spending. This will start to affect our bond yields. The world is pulling back. They're not buying as many bonds. As the Treasury continues to sell bonds, as there is not enough buyers, the yields will go higher, and that's where you create a massive problem. And the writing's on the wall for that. Jamie Dimon's been talking about that for about a year now, that the cliff is coming. I've reported this to you here on the channel. Now, I don't think this is a immediate concern. I don't think it's like the next couple of months concern, but by the time, we're mid-year, end year, 2025, 2026, this at some point will be a disaster. All of the deficit spending and just spending money that we can't afford. You can also see that the money supply, the M2 money supply, is shrinking year over year at rates last seen during the Great Depression. So the depressioners out there that think we're going into a depression, well, this data point would fit right in that category. And you also see commercial bankruptcy filings that are starting to rise. You're still at okay levels, in my personal opinion, but it's definitely on a worrisome trajectory. I think the biggest sign that there's some weakness coming out there in the economy is insiders selling out of the markets. This is typical. January, February of a new year, you get a lot of companies, a lot of CEOs, CIOs, COOs that sell stock to pay taxes, sell stock to get divorces, alimony, pay for their children's marriages, and all of this good stuff, right? So you tend to get a spike. Take a look at 2023. It was nothing compared to what you're seeing now. Now, if anyone knows that their company is about to slow down, the economy is about to slow down, it's probably the ones that are looking at the order flows of their company. If you are a Yeti, or if you are a Crocs, if you are some of these companies that have real-time pulses on what the consumer is doing, how they are spending money, even a Walmart, we're going to get Walmart earnings on Tuesday. That's going to be huge for our markets. Well, you're probably the insiders, right? You know what's going on. And if they are selling out of stock at unprecedented rates, that just makes me question, what is really going on with the U.S. economy? Now, I want to make the obvious point. Recessions will always happen. They're actually a function of a healthy economy. We have not seen a recession in about 15 years, minus the artificial one by the Rona. So you're arguably overdue. Even in 2019, it looked like we were heading into recession, and that would probably have been healthy at that moment in time to have actually seen a recession, to flush out the bad debt, flush out the bad companies that shouldn't be here, to reinvest capital, redeploy that into healthier, better places. That has not happened, and that's probably overdue at this point. But I want to caution you, it is an election year, so the Fed, at the first sign of weakness in the economy, they're going to be cutting first, asking questions later. It's all going to be as far as the markets and what they do. The perception of why the Fed is cutting will be very important. But really, the bottom line is, on a risk to reward basis, markets trading this high, the reward is not good. Right? The potential risk is too high versus the reward here. Just buying the S&P 500 doesn't look attractive here. Now, I will say for Tesla, if you do go into recession, maybe it's not such a bad thing at first, as long as it's a shallow recession, because the average Tesla buyer is higher middle class anyways. So maybe they wouldn't be affected as far as their jobs, at least initially, in a shallow recession. If it were to become a moderate or deep recession, that's where you have a bigger problem for Tesla. I will also point out, Tesla is nowhere near its all-time highs. Tesla would need to rally from here. Let's see. About 112% to get back to its all-time highs. So Tesla is more appropriately priced for the risk of a recession. So when you hear recession, don't automatically think a collapse for Tesla. Sure, upon the first rate cut or some kind of recession news. Would Tesla sell off? Probably. I think it would be a lot shorter lived than some of your other stocks that are trading at all-time highs. But really, I think all of this, the best thing you can do now, I'm not a fan of selling stocks for the long term. I'm not selling Tesla. You couldn't pay me to sell Tesla, just based on what I'm seeing out there with Tesla's AI opportunity. I want as many shares as possible, but I am reducing exposure in some other names. I completely sold out of anything related to China. I've started to trim some of the big winners. And I want to raise as much cash as possible because I don't know when the dookie's going to hit the fan and the fan's going to start spinning and spin off and hit me in the head. But I want to be prepared for the fan to hit me in the head. I want to put a helmet on first so I can, live to talk about that, because if that fucker came down on me, it's going to hurt. And that's exactly what potentially could be happening in the economy over the next 6 to 12 months. Again, it is an election year. You would see a lot of stimulus in that event, but then you kind of bring up the argument of if the government spends even more money from here, as governments and really people are revolting against treasuries. You can see that in TLT. Nobody wants to buy a dang treasury bond. You almost can't pay people enough to buy treasuries. Well, that's an even bigger problem. If the Fed starts to, print even more money and the government starts to deficit spend even more, you might see treasuries spin out of control into a sell-off that could drive rates higher even as the Fed is cutting rates. That's the dangerous part. If the Fed cuts rates and the bonds don't react, then you're talking about a collapse, a calamity, a total problem. And I guess we'll know that when that day comes. But you want to be prepared for that day long before it comes. And I think the time is now to prepare for some kind of downside, right? Stocks are at all-time highs. There will be downside at some point in 2024. Question is it, moderate? Is it a correction? Is it a 20% crash? Is it a total collapse? We don't know, but the signs are out there that, maybe the economy's not as strong as we thought. Markets are not priced for that. And everyone kind of shook off the retail sales data, which was really bad news. And not to mention inflation, CPI report on Wednesday, PPI on Friday also came in a lot stronger than expected. So add that on there, and you have a shit show Sunday for your Sunday. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one. Oh, and by the way, if you guys want to come trade with us live in real time in the trading community, come hit some trades with us, stack that cash so you can buy the dip when that dip does come. Join that trading community, link down below in the description of this video, and join the X account. Just go ahead and give it a follow over there. It's Michael Tyler. It's free $99. It costs you absolutely nothing to do so. That's it. Thank you for watching. I'll see you in the next one.